Hey everybody, Jonathan Broadbent here, your host of UnWoke.Academy. Welcome to another episode. This one is going to be short and sweet, a little bit of information and update to give to you. The plan is to go live every Wednesday at noon Eastern time, Wednesdays consistently. However, I have learned that I actually need to be in our state house tomorrow, Tuesday, and that's going to carry over into Wednesday. So I think part of the day, at least, I'm going to be at our state capitol in the State House on Wednesday, which then pushes us back. And I want to make sure to get this information out to all of our PMA followers. That is the Financial PMA. By the way, that is the website. It's financialpma.com. That is an offshoot or kind of a result of UnWoke.Academy. And again, hold on a second here. Let me take a sip of water. I should have done that before the show started. Or maybe make some tea with honey. And I've been using my voice a lot recently. And I need to keep my voice going. Darn. So we started as UnWoke Investing, turned into UnWoke.Academy. And then off of that, the research that we do and looking for calling out the woke companies and woke managers, woke Wall Street, as I like to call them, and then finding the non-woke alternatives to invest in. That has sort of been a natural progression. And as I said, the intention is to call things out and talk about stuff and open up the dialogue every Wednesday at noon. Wednesday this week, I will actually be out of town. I'll be in the State House. Who knows? Maybe I can figure out how to do it live from the State House from my mobile phone. I think there is an app for that with this software we use. But anyway, I want to make sure to get this info out this week. The first thing to know is that lots of people, when they look at investing, think indexing. And indexing is a really cheap way of doing investments. So, or it can be. Instead of the old way from our parents' and grandparents' era of buying and building a portfolio that you know of different stocks that has trading costs, what mutual funds and things like them did is embed that cost of buying and selling into a management fee. It's often referred to as an expense ratio. So a lot of people, when you're investing in an IRA or 401k or something like that, you don't see the trading costs, but they're there and they're deducted no matter what on an ongoing basis. And you have a little bit of a fee for the company that does the management. An alternative to that is something similar. It's a little bit of a hybrid. That's called an exchange traded fund. Those actually do have trading costs, but no management fees. Well, ultimately, we've gotten to the point in sort of the what I call the race to the bottom, which is to try and get the cheapest possible investment, that we've ended up with a lot of indexing. There are index funds, indexed annuities, index ETFs, and then some managers out there they've predicated themselves on indexing, which means they really don't have somebody that's there that's making decisions about what they think is a good buy or when's a good time to sell some stock or other type of investment. What they're doing is running an algorithm, running a computer program that's designed to replicate something or do something. And the most common way of creating software that does a big diverse pool of investments on behalf of other people is to base it off of an index. So let's pause. What is an index actually? Indexes, and you've probably heard some of them, they're referenced often. The S&P 500 is an index. That is not actually an investment. It is a method of tracking certain companies within the stock trading world. Same thing with Dow Jones Industrial Average, NASDAQ, and many, many others like them. So we've gotten to the point where it became easy, and I think a lot of people were lulled into allowing investments that were indexed and primarily indexed to S&P 500. Well, I see major problems that I've been calling out for a long time now with the S&P 500, which means, if I'm right, and the S&P 500 is set up, or it's actually allowed itself to turn into a big bubble I call the globalist bubble. That is, by the way, an episode. You should go back and watch that, and watch the episode where I show what I'm talking about. I show my work, Parade of Woke Sameness. Put those two together and you start to understand, which side am I on here? This. These are the companies that you'll see listed over and over and over again in many different types of do it for me investment options like mutual funds, and certainly a lot of index funds. So if people are out there, and you may be one of them, it's worth taking a look at. By the way, everything that I do, all the discussions that I have, I always use publicly available data. I do, as a financial professional, I have some things that are available to me that are behind a paywall. I use exactly none of those in preparing things like this. So what I've done, and actually I think Grok has a free version. I think I get Grok because I'm a paid subscriber to X, formerly Twitter, but whatever. Use your AI and you should find exactly the same answers. That just happens to be the AI that I use. But what you'll see, and in this list behind me, are the usual suspects. These are found over and over and over again in many different mutual funds, and that includes many of those that are actually managed, which means there should be, in theory, some team out there or individual who they're making the buy and sell decisions for you. And you may not, you don't see it, but you're actually paying for that. You're paying for the service, you're paying for them and their research and due diligence. But if they're not actually researching, and there's an argument to be made that they're not, if they're defaulting into basically the same investments everybody else is, and working effectively virtually the same as an actual index based investment like an index fund or ETF. And again, I just want to be crystal clear, those indexes are not themselves an investment. It's sort of a lens to look at a small section of the investing universe. So if everybody's doing the same thing and we end up with this mass consolidation, and you can see some notes and stats here. Let me open up my screen so I can read this. We have concentration as of June 12th. The 27 largest of these investments in the S&P 500 represent over 50% of the total value. So if those, and I have talked ad nauseum about how I believe those are overvalued. You have stocks in there. And again, I'm just going to use that same analogy that came from an economist that I listened to a couple of months ago. It was maybe 2 months ago. I listened in on it was a webinar, and this economist made the comment that if you believe in Apple stock, then you believe that we'll all live in Apple houses, drive Apple vehicles, wear Apple devices, and stream Apple services. That's an indication of how, and it's certainly very arguable, that companies like this that you can see in the list behind me are overvalued. You've got Apple, Microsoft, Nvidia, Amazon.com, Alphabet, Meta platforms. So Alphabet is Google. You know, Alphabet is Google. Meta platforms is Facebook, among other things. Berkshire Hathaway, Broadcom, Tesla, and JP Morgan Chase. And it goes on from there. The top 27 are like half of the S&P 500. And so much money has been consolidated into those that it's ridiculous in my book. Well, that in my book is where the opportunity comes in. So we've been looking at Trump's America First investment policy, which was released on February 21st, and we got a jump way ahead of that and started about a year ago in trading portfolios and suggesting investment portfolios for individuals, going back to what we all know works. If you want transparency and you want to know what you own, if you want to go unwoke and not be invested in things like this, and know for sure that you're not paying a woke manager to do the same woke things that all the other woke managers are doing to their woke clients in the world, if you want to escape that, the truest, purest way is to build a stock portfolio. I know it's not for everybody, but for some portion of your portfolio, or if you can get some help, and or if you want to take the dive and follow the shows that we do, walking you through step by step how to do that. The cool thing is, I mean, I'm looking at my smartphone now. It's super easy and it's really, really inexpensive. So a lot of people actually save money. So even with those really cheap, very, very inexpensive mutual funds and things like them, if you can eliminate the expense ratio, that cost of management, and drive that to zero, you will have trading costs. But for most people, and again, I want to emphasize, I am not a fan of day trading or trying to time the markets. I'm not suggesting it. I don't believe in it. I don't encourage it. Um, but for people out there who want to buy a long-term portfolio and know what they own, there really is no clearer, tried and true way than buying and building your own investments. And there's a world of difference when you get your statement instead of seeing a bunch of mutual funds and then not really knowing ultimately what they're invested in or having to do major research. And I'm a financial professional. It's difficult for me to lift the hood and figure out what's underneath. I do it, but it takes some work and some extracting, et cetera, to get to what's actually being invested in, and it's really never real time inside of those mutual funds. Build a stock portfolio, and often I find that people have vast, very significant savings. So there's trading cost, but I don't know, what are discount brokerages now, $5 a trade or something? Your offsetting fee, if you're paying, it really depends on the size and what your fees are, but I don't know, ballpark, whatever, $5,000 a year. If you're paying $5,000 a year in advisory and management fees, and you end up building your own stock portfolio, and if you have $400 worth of stock trades, and that's a lot of trading at $5 each time you're doing a trade, that's a pretty significant savings. It's just keeping more money in your account. So anyway, that's a lot of what we're talking about at UnWoke.Academy. And as I have very excitedly been reporting on, and I'm looking at some notes just off camera here that we just took today. So we've got a case subject. We've got a woman who last year, among all the people that joined the Financial PMA and became members last year, by the way, there's no requirement. No, you don't have to become a member. If you have another outlet or source or whatever, take the information, take the stuff that we talk about and run with it wherever. It doesn't matter. If you want to become a member, we'd love to have you. There is a fee for that, but that's just an available option among all options. This person wanted to become a member and wanted our help. And so I actually personally was hands-on, and on October 7th and October 8th of last year, in several different accounts, or actually this woman represent 3 different accounts, we did some stock trades. And so we built her a very diverse portfolio of, I want to say, I think she has around 40 in each of the different accounts. So that's all kinds of different companies involved in all kinds of different types of businesses all over the place. That's really the smart way to build any portfolio. So we did that. And from October 7th to just today, actually close of market yesterday, one of the 2 accounts has an average return now of, before I say the numbers, I want to say this is not planned for, and this is not something that I suggest we should drive for. When we put this together, we're not swinging for the fence. We're not trying to smash a home run, but we are trying to take advantage of the markets correcting, markets going out of the mass consolidation of kind of woke globalist companies and more into a free market economy where small and mid-size and some large companies that have been cash starved for a long time now are starting to get some capital and have some room to run. And that, I think, is exactly what we're looking at with these numbers. So I don't expect that we're going to be able to continue to duplicate this sort of thing, at least not for long, because the markets are going to catch up. The pendulum is swung, I think, or is swinging from very far left political influence and mass consolidation and what I call sort of the globalist communist sort of mantra that was really dictating and controlling capital markets through diversity, equity, and inclusion, and environmental and social and governance, and corporate equity index that kind of was the stick and carrot and whatever, all that stuff. I believe that that era is ending and that capital markets are actually returning. So when we launched on the first of 3 accounts, October 7th, her average return as of close of markets yesterday was 34.96%. And her unrealized gain, the weighted average return, was 37.80%. So what that means for anybody that's not clear on the difference between an average and a weighted average, if you figure $10,000, so you always talk about investing in a $10,000 investment, you can't, in the real world, you can't allocate that evenly among 40 different investments. One may get a little bit more because of the stock price, may get a little bit less. So this one has really taken off for her. We're at just under 38% in about 8 months. And in a second account, similar results. That one with similar dynamic actually traded on October 8th. That has an average return of 43.29% with an unrealized gain or internal weighted average return of 38.54. So what does that mean? It means that, and if you watch the last week I did an explanation of what the S&P 500 had done until through the end of May, which was around 3%, just a little under 3% point to point, and Dow Jones Industrial Average doing 0.63%. I remember the number, point to point. Those indexes, I suggest, are probably going to limp along with very low returns as they work out of the system, the mass consolidation that's happened. Too much investing in too few companies. And I think they have nowhere to go but down, I'm suggesting. So given that dynamic, the 2 circumstances, having the money coming out of, or it should, I really hope and pray that it does, come out of those mega overpriced globalist firms in the background, again, these and ones like them, and go into what could be the next big thing if it's funded well, and if it does well, and that's the hope right now. That's if you're one of those people that thinks, let's put America first, let's make America great again. If you believe in the value proposition of this populist movement that's taking place, let that carry over into your portfolio and let's invest for that. Because if this is your portfolio, this is the future that you're funding. It's these companies controlling everything. And there are lots of examples in there. You don't see Costco in this, but I did an expose on Costco and when they decided to stick with DEI. So they're pushing the racism narrative hard internally. Why would you want it in your portfolio? Why do you want to fund that? Some people may choose to boycott with their dollars, their spent dollars. We're among them. I actually have cut back and I let my Costco membership drop, but that's just me. I chose that. But I'm also equally, or maybe more importantly, I'm making sure that it's not in the portfolios that I'm encouraging people to invest in. Because if you stop spending your $500 a month or whatever it was at Costco, but you've got $500,000 invested in your portfolio, and a lot of that is propping up Costco stock, then you end up with a result where the senior leadership, the C-suite at Costco, are getting huge bonuses off of your money to do the woke stuff. So don't invest in it. And I am suggesting, for the time being, anything that's hugging an index, like an equity indexed annuity or an index fund or index-based ETF, or many of the providers out there. Vanguard is an example. Vanguard is primarily, or I think actually entirely, based on indexing. We'd have to double check that. The last time I did analysis of their management structure, that's how they were able to come out of the gate and over the last 20 years get so much money. They really downsized their staff by about 95% by running algorithms. Well, for a while, when those markets were running and we had the move into consolidation, it proved to be fine for everybody because everybody was making money by taking it away from small business and free capital markets, free business enterprise. But now that the world's kind of waking up to what that means, and they're thinking, hey, if I'm in 20 different Vanguard funds and they're nearly identical because they've indexed, then you're not nearly as diversified as you think you are, and you're paying to fund this stuff. So hopefully it makes sense and is easy enough to understand it at a fairly basic level. Just double checking the comment section here. I see a few familiar faces. Welcome, friends. I don't ever like to mention anybody's name. Everybody's kept confidential who communicates with me or with the UnWoke Investing, UnWoke.Academy, or Financial PMA. Again, the website is financialpma.com. Head on over there, check it out. Do remember to like, follow, and share. Let's get this information out. My hope is that some people, it clicks and they decide to become members or support us otherwise. But again, there's no obligation for that. Everything we're doing is shared publicly because my hope is that enough of us wake up to realize that we're actually funding our own demise with a lot of this stuff. We should get back to and absolutely adhere to the fundamental principles of the America First investment policy issued again by Donald Trump. You can find that. Let's see if I can add it to the show notes again. You'll see me reference it a number of times on UnWoke.Academy. That is a document released by Trump on February 21st of this year, 2025. Put all that together, and we just simply need to take our funding, take the money away. Let's defund the woke and put it into the companies that we can feel confident about and know, like, and trust. And heck, if you're able to get that statement and see the actual companies that you're invested in, clear and simple, there's never any ambiguity, there's no gray area, and there's no manager to pay. That's something at least worth considering. You can also expect to do that same sort of thing inside IRA accounts. That's perfectly legitimate. 401k plans, some allow it, and you're certainly well within your rights to go and ask your HR department or CFO to allow them to ask them to allow you to add self-directed brokerage account. That's what it's called, when you can trade and build portfolios inside of your 401k, not relying on a manager who might be woke. Episodes 124, 125, and 126, a three-part series called Behind the Veil on 401k plans that explains it in greater detail. I'm Jonathan Broadbent. Thanks again for tuning in and listening. If you have questions, feel free to post those or send a direct email to info@UnWoke.Investing.com. I'll do my best to get answers back to you. In the meantime, take care.